Welcome to Lecture 18, the nitty-gritty of price patterns. So we're going to go over the various patterns that we look for in the market to execute trades. So to start off, we're going to talk about how we draw boundary lines on the charts. And we don't need to be extremely scientific with it because the stuff just isn't that accurate. We want to be thinking in zones, not exact price levels. There's too much noise in the market for a very, very exact line to mean much. So we're going to use thick lines to draw patterns on the charts. And we're just trying to get a best estimate of where potential demand and supply exists. So the key really with this whole thing, there's nothing magical here. It's to find areas of compression, coiling, and consolidation that will fuel a nice trend once price breaks out of that compression, coiling, and consolidation. So now you can kind of see where this is coming full circle. We talked about this natural ebb and flow from the compression, coiling, consolidation to the trend, and that's all we're trying to identify. We're not trying to find a magic pattern on a chart. So for example here, we see FireEye. This would be very, very thin lines where we're getting very exact on exactly what a breakout is. When in reality, we want thick lines, okay? These are more of zones. We want to see candles drastically break through the lines. We're not looking for technicalities here with 1 cent or 2 cent boundary areas. We're looking for just a general coiling congestion area that will show a potential breakout and trend. So now we're going to get into the actual patterns, and I've subdivided them into categories here: continuation, reversal, and both. And there's really nothing new here. These are pretty popular patterns that people look at in the market. So we're just going to go through them really quick to refresh everyone's memory on them. And we're going to start with the reversal patterns. So it's a very, very common reversal pattern, head and shoulders. And you can see it drawn down here. We got the left shoulder, head, and the right shoulder. And then the break of the neckline leads to a breakout. Same thing with the inverted head and shoulders, except it's just flipped upside down. We got shoulder, head, shoulder, and then a break of the neckline leads to a breakout in the other direction. So this is one of the most common and well-known reversal patterns. The normal head and shoulders is for tops. The inverted one's for bottoms. And we want to usually see a trend prior to the head and shoulders reversal. So we're going to want to see something that, trends up, makes its little head and shoulders, and then reverses. Versus something like going sideways and then we see like a convoluted head and shoulders and then go. We typically want to see a trend up, the head and shoulders, and then a reversal. And then overlap and symmetry in the shoulders helps as well. The more clarity, the better. So clarity here would be a nice clear shoulder and head. Something that's a little more convoluted maybe would look like this. So it's not as clear with two shoulders and a head, and this is better than the other one. But these can still work, but our focus mainly is on the clearest patterns. So here's an example of a very clear pattern on the quarterly chart for British pound. You can see how the shoulders are very symmetrical and we got a nice head here. And here's an example of a more convoluted head and shoulders where it's not exactly symmetrical. This shoulder's a little shorter in length than this one, and you could argue that there's potentially another shoulder here which would make this a complex head and shoulders top, but this one still ended up working out. And the actual intricacies of the head and shoulders isn't quite as important as that very clearly defined boundary line that defines the consolidation when the breakout occurs. Here's another example of an inverted head and shoulders, and this is after the 2008 crash. You can see this is not perfect either. We have a different looking right shoulder than the left one, but the key here was, again, the horizontal boundary line. So head and shoulders, we prefer clarity, but we don't need exact clarity. Remember, this is not an exact science. We're just looking for something that resembles a nice congestion area that could potentially lead to a breakout. And here's another example of head and shoulders on crude oil. Again, a little bit longer shoulder on the right side, but a very, very, very clear horizontal neckline. And these are always the best ones with a very clear horizontal neckline. So be on the watch out for that. And don't get obsessed with the exact shape of the head and shoulders. You're sort of missing the point here. As long as it generally has a spike down that comes back up and then makes a higher low, and that's consistent with the other shoulder on the other side. Now let's segue into double and triple tops, and it's pretty simple. We just have In the case of a triple top, right, just 3 hits to the upside before a move. And in the case of a double bottom, just 2. This is another very common pattern in markets that we like to look for. So a lot of people like to say, hey, double tops look like an M for murder, and double bottoms look like a W for win. And the more pronounced, the better. With all these patterns, the more pronounced, the better, the more clarity. Remember, we're looking for the absolute best to best clarity to execute on. So if you're sort of on the fence of whether something's a double top or double bottom, just simply skip it. And triple tops look a lot like rectangles, but usually they imply reversal or continuation. So here are a couple examples. Here's a triple top in Apple. You can see ding, 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 and then a nice breakdown. This could also be labeled as a head and shoulders, but since the shoulders come up to an area near the head, it's much more appropriate to call this a triple top. And here's a good example of a double bottom in the E-mini S&P futures. Very, very simple. We see we came and faked out, made a slightly lower low, and then ripped to the upside. And the break of this horizontal area would be a signal for an entry. Rounding bottoms are just much more stretched out bases after something that gets bombed out, and then we see a break above a horizontal line. And so the first half of the rounding bottom usually involves falling price, and this low is tested for an extended amount of time as price is consolidating, and it should be a full out bottoming, not a V shape. So we shouldn't see something like this. We want to see a fall and then lots of resting. And we see this a lot in bombed out markets or stocks that get absolutely killed. They come down from something like 50 to 5, and then they trend sideways for a very long time before reversing. So here's a good example of that in Cliffs Natural Resource. You could see here, this stock got absolutely decimated, and then it came down to this saucer bottom formation, and we started just kind of going sideways, and it was very low activity, and it took a lot of time to develop. And then here's another one in Cloud Peak Energy, very, very clear here. And again, this is the classic setup of a beaten down sector, beaten down stock that then goes on to quietly consolidate for a long, long time. So this consolidation was over a year, which finally led to a nice breakout. So now let's get into continuation and reversal patterns. So here's the symmetrical triangle where we have a slanted line on each side of the consolidation, and this can break out either way. The key with the symmetrical triangle is that we get a contracting range and it looks like a coil. So this is a great example of the volatility compression that we were talking about, how the price range gets compressed and then it shoots out one way or the other and forms a trend. So here's a good example on the 20-year bond ETF from iShares. You could see how price kept coiling and coiling in a tighter and tighter range before shooting out to the upside in the beginning of 2016 and forming a very nice trend to new highs. Now the ascending triangle is a little bit stronger of a pattern because we have that horizontal boundary line. We always prefer horizontal over slanted. And this is simply one that just uptrends and coils, but with a bias. So we keep on making higher lows as we go here, and there's resistance, and finally the market just can't resist it any longer and it blows off to the upside. So these things are primarily bullish. Once in a while you'll find them that will complete a bearish breakout, but the ascending triangles are primarily bullish, and they're a signal of active accumulation. We get that same compression, volatility, contraction, followed by a burst which forms the next leg. So here's a great example from Novotel Wireless, and we can see a very, very clear ascending triangle with that key higher low and then an extremely clear breakout from a horizontal. So these are very, very strong patterns and usually lead to nice extended moves. The descending triangle is the exact opposite, just a slanted line downward, breaking off from a horizontal. And it's primarily bearish, mostly found in downtrends. The rallies are sold, creating lower highs, but there isn't quite enough selling pressure to break that support. And finally, prices compress so much that the sellers overwhelm the buyers, and we get the breakdown from the horizontal support area, along with expansion and volatility. So here's a great example on silver futures, a very, very clear descending triangle. And we see a key here is that lower high and then a solid break out of horizontal support that ended up having a pretty good trend for a few months. Rectangles are two horizontal lines, resistance and support. Very clear, very strong patterns. And again, it's just it's a compression in a coil that leads to a breakout. They can break out either way. And they're similar to a triple top, triple bottom, but usually it consolidates longer. So after 3 times, we don't say quadruple top, quintuple top. We just call it a rectangle. And they're extremely powerful and strong price signals. So here's a great one in the British pound, US dollar. And you can see it's just a sideways channel, very, very clear consolidation area. And then when it breaks, an instant trend to the downside. And these patterns are some of the most strongest patterns in the market to look for when we have 2 horizontals, extremely clear. It shows the compression, and then we see the expansion that comes out. A channel is just a slanted rectangle. It's not as strong because we're dealing with diagonal lines, and so that makes it less reliable. Here would be an example of that. And this is an India index fund, and we break the channel right here and have a decent trend. So these patterns do work. They're our least favorite though and least reliable, but be on the lookout for them. You can test them in your own process if you'd like, but generally diagonal lines are not going to work out as well as horizontals. And here's the cup and handle. A lot of people know about this one. It can happen as a reversal or a continuation pattern, usually in stocks. And this is a bullish pattern only, so we don't see cup and handle bear patterns. And it's a combination basically of a rounding bottom with a flag. And like I said, it occurs most frequently in equities. So here's a good example out of Home Depot. We have a nice little dip, comes back up to prior highs, consolidates, and then launches for the next leg of the move. Very common pattern. Here's Cliffs. A nice dip off the highs, back up to the highs, consolidating right at prior highs, and then a nice strong move out of that. Very powerful pattern for equities. Here's Gafisa. Same thing. A dip, back up to prior highs, a nice consolidation and compression that leads to an upside move. Next is wedges, which are slanted symmetrical triangles. So if you remember, the symmetrical triangle looked like this. This is just if you were to slant it and turn it down or up. And powerful reversal pattern. They can be continuation patterns as well. And the thing about these is they contain those coiling characteristics that set up a very, very powerful move. And they can slope both ways and either continue or reverse a move. So here's a nice one off of crude oil futures. We see a nice compression in range all the way down. This got a little dirty right here on the lows, but the break to the upside did basically put in the lows for the downtrend. And here's another one in iShares Russell, except this is sloping to the upside. So we see 2 horizontal lines, we see a compressing range, and then a breakout which led to the 2013 rally. And now we're going to get into continuation patterns. These are smaller, minor patterns, and they occur in the middle of trends. So people know them as flags, and this would be an example of a bull flag and a bear flag, and pennants, which are basically just slanted lines instead of horizontals. So they can be thought of as mini triangles or price channels, and they're in shorter duration, and we use them to enter or add to a trend after the original breakout. So you're not really going to see these as a move starter because they're smaller. Flags always slope away from the trend, so a bull flag is always going to slope this way, and a bear flag is always going to slope this way. It's a counter trend move. Pennants mostly slope away from the trend, but can sometimes slope towards the trend too. So pennants can go either way on this one. And here are a few examples. So here's a nice little bear flag on the Aussie dollar, and this is very common where we see a nice down move with a little bit of pause and a counter trend mini consolidation followed by a continuation. And here would be an example of a uptrending pennant. So we have a nice strong move, and you can see this was a upward slanting pennant that eventually led to a breakout that continued the move. And finally, Euro FX US dollar cross. We can see here that this looks like a mini triangle, so we would call this a pennant. It's not necessarily sloping either way here, but just a very mini consolidation that you can use to add to a potential trend once it breaks down. So when we're doing chart analysis, we want to avoid what's called Rorschach analysis. And chart patterns are not an exact science, but their rules and pattern definitions need to be strict enough so to prevent you from injecting your own confirmation bias. And that's because if we just label anything as any old pattern, we see any old congestion, and just draw some lines in the chart, we can end up injecting what we think or what we want the market to do rather than having an objective opinion about what's going to happen. So As a general rule of thumb, that'll keep you safe. If you can't spot a price pattern within seconds after looking at a chart, you're likely injecting your bias into your analysis. So the opposite of what we want to do is look at a chart and then spend 10 minutes trying to find a pattern and then maybe find a pattern. These things should be jumping right out at you and being extremely clear and extremely obvious, because we don't even want to spend time on the stuff that's hard to find, that's not in line with our Sturgeon's Law concept and our outliers concept and our searching for clarity concept. So the takeaway is there's nothing magical about price patterns. They're not an exact science. We can use larger lines to define the boundary areas. And they mainly work due to the volatility compression expansion property in markets, not because there's some magic little formation. So, there's nothing magical about a triangle. It's just the fact that markets tend to go through periods of consolidation and trend. They ebb and flow in that manner. And classical charting is just a simple and concise way to organize the otherwise complex charts of financial markets. So classical charting is a tool to help us organize and find potential trades, but it's definitely not a crystal ball or anything like that. So keep that in mind when you're using these patterns on the markets, and I'll see you soon.